this is a chart that I had showed, well, probably 6 months ago, and it's the probability of recession according to the New York Fed's own model, and what they're and it's comparing that to high yield credit spreads. Okay, and the New York Fed's probability of recession model is one that is based on yield curve inversions, a lot like our own yield curve inversion model. We actually think ours is even better, and Tavi is the creator of it. But it's neither here nor there, because they're both saying the same thing. They're both saying that yield curves have been record inverted for a record length of time, and the twist on Tavi's is that it's a percentage of inversions across the whole yield curve, and the Fed's model is just focused on 3-month versus 10-year, or something like that, just on one of the spreads. But they're both signaling a high probability of a recession, and it's been signaling this for a long time, and so this is the probability of a recession 12 months ahead, keep in mind, and it's at 58%, which is the highest it's really been in the history of this model since just a few months ago. But every other time when the probability has gotten this high, or has been above 40%, we've actually had a recession. And what happens in a recession? High yield credit spreads blow out. So the spread between junk bonds and the 10-year Treasury note will go anywhere from 10 to 20% above Treasury yields. And where are we today? We're near record low tight credit spreads at around 3.7%. So this is a trade that we have on in our global macro fund. We've been out of this trade for a while, but we are getting back in because we do believe the probability of recession is increasing. In our view, the probability of a stock market meltdown is increasing, and we'll get to that here next. So I've been pretty busy, trading here and today, and I didn't have a lot of time to prepare a bunch of slides. Tavi was kind enough to share a bunch of his. So I'm going to talk about some of Tavi's slides today, and he's got a bunch more to share with you as well. So don't fret. So here we're looking at the NASDAQ 100 index. This is where all the mega cap tech stocks are parked, and we're comparing it to money supply, and it's just another way of looking at valuation of mega cap tech, and seeing even with the record money supply that we have out there, seeing how high stocks are valued relative to that. And valuation risk is one of the key factors in this market, at the same time as we have rising interest rates, rising inflation, that we believe is a catalyst for a stock market correction, if not a much bigger stock market crash, and a potential recession ahead to follow that. And we think it's of the stagflationary variety for a number of reasons, which we'll show, which we've always been showing, we'll continue to show. But let's go on to the next. So what happens in a stagflationary recession? This is looking at the 1970s. When you have rising inflation, a lot of people think inflation's good for stocks. Well, not really. Rising inflation causes shrinking PE multiples because the cost of capital is rising, and it causes valuation multiples to shrink. And so when you have record high multiples, which we have had across the S&P 500, and especially for mega cap tech stocks, and you have rising inflation at the same time, rising interest rates, it's a catalyst for shrinking multiples. And look at what happened in the 1970s, 73, 74 in particular, when you had significantly rising inflation, you had stocks falling. Let's go on to the next. Another interesting thing that we're seeing now is that as inflation expectations are starting to increase again, as reflected in the 10-year break evens that are implicit in the TIPS treasury market, we're seeing that the correlation between VIX, which is the volatility on stocks, the S&P 500, is, we're seeing a positive correlation between rising inflation and rising VIX. And it's the highest positive correlation on a 52-week trailing basis that we have seen in the history of VIX or of 10-year of both of these things together. And so rising inflation expectations, rising VIX, this is not a good combination for overvalued stocks. Let's go on to the next. A lot of people are saying, but Kevin, there's record money on the sideline. Look at money market funds, record levels. And, it's true that money market funds are at record levels, but let's compare that compared to what? Let's go on to the next. Compared to the total U.S. equity market valuation, money market funds are actually at near historic low levels. Okay, at market bottoms, when we have record cash relative to equity market cap valuations, that's when there's record cash on the sidelines, like we had at the market bottom in 2002, like we had at the market bottom in 2009, not like we have today. This is not record cash on the sidelines, another risk for the markets today. I think that's probably all I have, but let's just make sure. I got one more, courtesy of Tavi again. And this is a pitch for gold. I know Bitcoin has been popular as an inflation hedge, as a hedge against global fiat currency debasement, which has been our long-running precious metals theme for years, and why we own gold and silver and gold and silver mining stocks. But what is Bitcoin? Bitcoin is NASDAQ times 3. That's what Bitcoin is. And look at the correlation between 3 times leveraged NASDAQ 100 and Bitcoin over the last 5 years. And it's if it looks like a duck, walks like a duck, and quacks like a duck, then it just may be a duck. Why does it matter? Well, gold is a traditional hedge against fiat currency debasement. That's what we're focused on here at Crescat. And we do think Bitcoin is much more of a speculative asset that has been a beneficiary of the easy monetary policy. Yes, but is it really a safe haven monetary asset like gold? We don't think so.